All right. It's Thursday, May 18th. I'm here with EY from SoFi. That would be Liz Young. This is Market Call. Market Call is brought to you by our sponsors, FactSet, financial data and analytics, powered by Tomorrow. And of course, SoFi, get your money right, all in one app. Do you do it all in the app, Liz? Or do you do
a
it?
lot of stuff in the app.
Yeah.
My content's in the app, all the money's in the app. You can get everything in there.
Well, it's a great platform. I am
scores.
a SoFi customer, and it is a great dashboard, and you can do all of those things like you say about getting your money right all in one app. So there you go. All right, we're here. There's no Guy Adami here.
I know.
So
just the two of us.
Listen, good for Guy Adami and his son Guy Jr., who is a great little lad. He is graduating from his alma mater, from Guy Senior's alma mater, which is kind of cool. So that's happening today. So shout out to Guy Jr. And shout out to Guy and Linda. They have had 3 kids graduate college in 3 consecutive years, which is absolutely great. All from Georgetown too. How about that?
Wow. That is actually quite impressive.
Yeah, it is pretty amazing.
All jokes aside.
Yeah, no.
That's
And Guy and Linda, they have stewarded this whole process. So Guy, as he likes to say, when I'm out, a well-deserved day off. So here's another thing. This is truly amazing. I don't know if you were watching the 9 o'clock show on CNBC this morning with David Faber, who
I was not.
All right. Well, I was. I'm a huge Fabes fan. You know what he's doing right now? He is at Citi Field. He is getting ready to throw out the first pitch.
He is?
Yeah, that's pretty cool. And he is a lifelong Mets fan, so that's pretty cool.
Oh, man.
Yeah. So he's doing that. All right. Well, listen, we got a lot to cover here today. So, yesterday's market, Liz, I thought was pretty interesting because the way that Speaker McCarthy walked out of the White House 2 days ago now, and the way Schumer walked out of the White House, very different than the week before. And, the rally in the market just started building throughout the day. I think people were starting to feel a bit better that this was not going to go down to the brink and it wasn't going to be this hugely partisan sort of situation as it relates to the debt ceiling. I think there's a little enthusiasm about that today. There were some headlines. I think we have one of them right here from Senator McCarthy. Speaker McCarthy, that would be in the House. I mean, he's basically saying we could have a bill on the floor. This is a bipartisan bill that will pass, not the bill that they passed last month that was calling for $5 trillion in future cuts and spending and that sort of thing. What does that mean to you? Does that lift some sort of because the market hasn't been pricing it, the VIX hasn't been pricing it. Does that lift something off the markets here? I'm not sure.
I mean, I don't know that it lifts a ton off the markets. Even just looking at the pattern right now, right? The Dow's down pretty sharply compared to the S&P and the NASDAQ, but the S&P is only buoyed by tech, communications, the growthy stuff. So more of a rate sort of move, or the expectation that maybe things aren't going to be terrible or whatever the case may be. But here's the thing about the debt ceiling. I think that it's going to, maybe in the very, very short term, let's say they pass something next week. That's the most recent headline I saw, that next week was more likely. Maybe they pass something next week. We'd have a little bit of a relief in the sense of, if you had looked at credit default swaps on treasuries, the 1-month version, they had gone up quite a bit.
So just to be clear, the CDS is basically insurance on those underlyings there. And so the fact is they never really blew out, right?
They never blew out, but there was a big rise over the last few weeks. So there was obviously an increase in the expectation or the possibility that there would be some sort of U.S. debt default, right? So you might see a little rally as those come back in and people decide, all right, we're not going to default in June. But it doesn't necessarily solve the problem. I mean, I don't know what this bill looks like, but there's a chance that it's just a temporary
kicking
relief.
the can down the road,
right?
I'm sure.
And then we get to September-ish. Budgets have to be done before October. That's where it really comes to roost, and we'll see what happens then. But here's the thing about this whole cycle, including the debt ceiling, the timing of it. I'm starting to think the timing of it, and if you can get the timing of it right, that's where you win. It's not so much about, these are the signals, this is what they're telling us is going to happen. Even if you're saying a recession is going to come, there's going to be some big shock. So far, we all sort of look wrong, right? So it's more about, well, how long does that take, and how many cans can we keep kicking down the road?
Yeah, it's interesting to me when you think about some of the incentives that are in a lot of the fiscal spending and a lot of the fiscal, like this IRA, it's geared towards some of the areas of the market that have worked really well over the last, let's call it, year or so, and when you think about chips and the like here. So I kind of think it's interesting that there will be a big budget debate. The likelihood that it centers around this debt ceiling is kind of silly. And the last thing I'll say about your point about the CDS on treasuries, after what we just went through with regional banks and not hedging their interest rate risk, that could be a function of some of these banks, large and small, just saying, hey, we better have our ducks in the row, because if things do hit the fan and we are not properly hedged with some of our holdings, we are going to get doubly punished, because again, based on what happened in March. Let's look at the S&P 500, because it's kind of interesting. We've talked about this really tight range that has been in for the last 6 or 7 weeks or so. We look at that February 2nd high before, the regional banking crisis. It was about 4,200 in the S&P 500. Look where we got to today, 4,186 or so. We kind of sold off, I think about 20 handles or so. Technically, Liz, and I know that you kind of take an eye, you look at the charts every so often. I mean, we've been saying this for like a couple months now. Like, the chart looks constructive in the S&P 500. Take it back all the way to the spring, and you have the potential for a breakout. I guess what Guy and I talked about a little bit yesterday is like, what is priced in for the potential of volatility around 11th hour sort of negotiation around a debt. I don't think much, especially with a VIX below 17.
I would agree with that. I think that this market, and it's interesting, this range just keeps getting more and more narrow, which is kind of wild, right? And that, to me, because I'm more cautious, says that we're actually ripe for it to move bigger coming up. I don't know which direction it's going to move, but when you're kind of stuck in this little area where it doesn't seem like, number one, not much is happening, right? We've finished earnings season. There hasn't been any really big headline aside from the fact that the debt ceiling is heating up. But this tells me that we are actually ripe and almost fragile for a little piece of news that surprises us to move us in a different direction. The biggest thing that I can imagine through the rest of the year, maybe even through summer, is that there's still such a big gap between what the market thinks is going to happen with rates and what the Fed says is going to happen with rates. And inflation is a huge piece of that. The labor market is a huge piece of that. Housing is probably a huge piece of that. So there are opportunities for us to get data or get a statement from the Fed or some kind of shift in narrative from somewhere that moves this in a different direction.
It's interesting that you mentioned this range, and it's kind of it's getting narrower, and it feels like something's got to give really soon. It'll be interesting to see. Let's just say we wake up on Monday morning and there's some sort of timeline about a bill that's going to be presented that both parties think is going to pass. It'll be interesting to see what sort of move that we get to the upside, because that clearly would be the sort of thing that people would go in and buy. You'd cover shorts, that sort of thing, especially if you were playing for like a disaster sort of scenario. But let's see how long it holds, and let's see if it can build, because to me on that S&P chart, again, that 200-day moving average down there at 39.75, it's basically in line with that uptrend that's been in place since the October lows. That'll be really interesting. All right, you just mentioned rates here, okay? And just like the stock market or the S&P is at a 1-month high, the 10-year yield is at 3.64, which is also a 1-month high here. We just threw up a chart. You see the downtrend from late last year's highs in the yield, which was very near 4.25. It probably gets you right below 4% if we were to break out of this range and get towards that downtrend. That would clearly be resistance. And then you see that kind of support level. We were banging around that 3.3 level or so a few times earlier in the spring. That looks like pretty decent support. But I think it's interesting. Danny Moses, our good friend and co-host of On the Tape on our Friday edition, he put this woman, Lori Logan, on our radar early last year. He said she's going to be a thorn in the kind of dovish side of some of those in the Fed. And this morning, there's a Bloomberg article, but she was quoted as saying that she doesn't see the case for a June rate pause with prices still high. To your point, that sticky part of this inflationary story, which is wages, and it is the jobs market, the unemployment rate at 70-year lows.
Yeah, I do see a pause in June. And poor, what's her name? Lori
With an O.
Oh, Laurie.
Oh,
anyway, sorry for calling her a thorn. I do see a pause. I think that they can justify a pause for a lot of reasons. Yes, inflation is still high, and yes, rates are still elevated compared to where they have been for the last decade. But you could also argue that rates at this level is much more normal. One of the things that's really interesting
normal, especially relative to inflation being above the Fed's target.
Yeah, and also, I mean, just as a caveat, there's a sweet spot for inflation between 1% and 3%, CPI between 1% and 3%, where the market tends to go up or at least do okay. So I will not also be surprised if the Fed starts to change their tune when we near 3% instead of 2%. Will they admit it? Outwardly, probably not.
But it's funny. So how do they do that in a way? Because this 2% was the target on the upside pre-pandemic. It's been the target even when we had high single digits late last year, when we had a 9% CPI, they're still talking about 2%.
Yeah.
And wouldn't that have kind of give them the cover and say, listen, the economy has changed. The dynamics in the jobs market have changed. The pandemic changed that. And we think that the natural rate is going to be higher. And here's why. Like, they have the opportunity to do that. Now that it's falling and it's going to be nearly cut in half in a month or two, at least the CPI readings from their highs, wouldn't you think 40-year highs, wouldn't you think that they kind of missed their opportunity to reset the stage there for inflation?
I don't think so, because I think that they needed to make that the consistent message, and they didn't want people to work in some kind of margin of error above 3% and set expectations that, oh, they'll stop at 4. They said they'd be happy with 3, then they'll stop at 4. So they had to stay on this 2% narrative. As we get closer to it, things will probably show some more stress. We're going to see things in the market that are cracking, right? There's probably going to be some economic data that's softened even further. By the time we're nearing 3%, we'll probably have had at least a flat, if not a negative GDP print. And then they'll have the excuse to say, okay, look, growth has slowed considerably. We're a little bit concerned about some of this other data. 3% is a far cry from 9%. So we see the possibility that as inflation continues to soften, we could consider cutting rates, right? It would be like the tiniest little changes in their words. But as we know, the market changes on the tiniest little changes in their words. So I don't know that they need to necessarily say anything about it until after they have paused for a while. And then it's the conversation about, all right, when do we cut?
Well, it's funny. It takes me back to late 2018 when Fed Chair Powell had started, the prior year, just kind of this rate hiking cycle. They talked about normalizing interest rates, right, off of that zero interest rate bound that had been there, since the financial crisis. And so to me, what I think is interesting is like when, we had this kind of rate moving higher, right? Inflation was still low. The stock market didn't like it, right? And we sold off 20% in Q4 of 2018. So I just kind of wonder, like, if they're able to thread the needle and maybe get market participants or companies or, whoever it is. It's not just market participants. We're looking at this data. It's companies, the way they forecast, right? CapEx and hiring and all this sort of stuff. And so to me, I think there's a narrative to be told that, okay, maybe we can deal with lower unemployment rates, right? With higher inflation and rates just higher. Maybe that's the normal sort of going forward. All right, let's talk about the dollar here a little bit. I know this is a topic that you track pretty closely. It's something that we've been following as relates to U.S. multinationals and their earnings. And we had this huge round trip, right? So we saw the dollar go, the Dixie, the U.S. dollar index go from like 100 in early 2022 up to like almost 115, round trip the thing. It's kind of found some support here. It's rallying a little bit here. Thoughts on what this means to the kind of rate outlook and what it means for kind of corporate earnings? We know that corporate earnings, while they were better than many people expected in Q1, like they had this tailwind of a lower dollar in the quarter, especially kind of year over year.
Yeah, what's interesting, though, and I know we talked about this on Market Call either last week or the week before, the weakness in the dollar was not as much of a buoy for multinational corporations, right, as we would have expected. Part of that being the weakness in the dollar is occurring for different reasons. I think the strength in the dollar was occurring when the Fed was continuing to hike and everything was a little bit different here than it was overseas. Now it's almost like there's been this tiny little shift of, you know what, things aren't that great in the US, and they look like they might actually be getting better elsewhere. Maybe not necessarily in Europe, but who knows? Asia might be getting better. Japan actually is even looking a little better. So there's a possibility that the speed of this and the leaders and the countries and the regions that are taking over change a little bit. If the Fed comes out and says they're pausing in June and we still have a market pricing in cuts later in the year, I think the dollar probably weakens even further, but I don't think that necessarily helps corporate earnings. There was a time earlier, let's say a year ago, where I said something like, I don't even see necessarily the VIX as the fear gauge. The dollar is the fear gauge. I don't think it's going to work that way in this environment with the Fed having to pause and slowing growth and stagflation here.
Yeah. And a year ago, I mean, the dollar was a flight to quality as the euro was getting nailed, right? With the war, in Ukraine here. And it's worth noting. And again, a lot of you guys will say, well, the gold weakness is just commensurate with what the dollar has just done the opposite, right? And if you look at the GLD, the ETF that tracks gold, kind of interesting here. It made a bit of a double top going back to a year ago. Its closing high, which was a multi-year high, we just got there about a month ago. I think that was probably the height of the issues with the debt ceiling. It was also the lows in the dollar, and you see that uptrend that's been in place since late last year. So that'll be a really interesting level. You see the 200-day moving average all the way down there at 170 or so. talk to me. I think you've definitely been a proponent of, a small percentage of your portfolio in gold. Is this a back and fill? Does this give you I think Guy would probably say this is probably the opportunity at that uptrend, maybe towards 180 is where, if you haven't been in gold, this could be a good spot to do that.
I would agree with Guy on that. And it's funny. I mean, this is such a short-termy market, right? Gold, I'm looking at a chart. I'm kind of eyeballing this. Let's say it peaked on May 4th, and it's shown some weakness since May 4th, guys. Today's May 18th. Okay. So that's
short-termy. Is that what you called it?
Short-termy. 14 calendar days of weakness. That is not a long enough time to say it's over. The gold trade is over, right? And if you look at that time frame, we've had maybe some optimism on a debt ceiling. We've had a rally in rate sensitive parts of the market. Not surprising then that gold would give a little bit back in that environment if fear has left and people don't necessarily need, to worry about a debt default in the US. That's probably not the thing that takes gold back up again, but I do think gold still has at least support, if not more upside beyond what it saw on May 4th. So I would agree. I think this little dip is an opportunity. If you haven't been in it, I would put some stuff in it.
It's also it's the recession trade, right? So if we do have a recession and it comes harder than folks think, and then there's something else that happens, let's say in the economy or in the markets, the Fed's playbook is to lower interest rates. They lower interest rates, they weaken the dollar. You weaken the dollar, you have gold going the opposite way. So why do we spend a lot of time throwing up all these beautiful fact set charts on the screen as we're talking about this stuff? Is a lot of traders, they use technicals to help inform entry points, exit points, stops, and the like, inform your option strikes, if you will. All right, let's talk a little bit. You wrote your note on the
I want to go back to one thing.
Oh, sure.
Sorry.
Whatever you need to.
The market stuff. So this is more about yields. I want people to go look at, if you have access to it, go look at a chart of the 2s, 10s inversion and look at the range that it was in before SVB failed. It was in a range of, let's say, inverted 80 to 100 basis points for almost 2 months, if not at least February into March, and then inverted beyond 100 basis points. SVB failed. Regional bank stuff happened. It shoots back up, and it's only inverted about 40 basis points. Now it's stuck in a range between 60 and 40 basis points. So the environment has changed. The level of inversion has changed. And as we've talked about many times, when the curve uninverts is the signal, right? So we didn't quite uninvert yet, but we've certainly made we've certainly made headway to get to that uninverted level. And now we're kind of stuck in a more shallow inversion. So I would argue that this is saying we are closer to a recession. The next time it jumps back up, let's say we're in a range of 20 to 40, right? It's just almost like this stepwise function telling us it's coming.
Yeah, it's funny. And again, like on a day like today where I see, the S&P up like 30 basis points and I see the NASDAQ up 1.25, and some of our favorite AI bubbly names are just raging right now. I mean, NVIDIA is up nearly 5%. We're going to talk about the semis in a second here. It just feels like a little fear in this market in front of, okay, the debt ceiling. I was never in the camp that this was going to be like a default 2011 situation. And I get how the politics are different this time, and the way, Speaker McCarthy and the hold that he has on his caucus is that is a definitely different dynamic. I just think that given what we just went through with the regional banks, we are on, I think, shaky footing right now, if you think about like the financial system. And that brings me back to 2008, where a lot of folks thought that, Bear Stearns problems were Bear Stearns problems, right? And then you put them in the arms of JP Morgan. Well, that's backstopped, right? We've ring fenced all those issues. And we know from history that wasn't the case, right? And so that's why I don't really think we're out of the woods when it, as relates to this regional banking crisis, especially when you have Fed speakers like Lori Logan saying that I don't think there's a great case for a pause at this June meeting, right? Because if rates were to continue to go higher, we could have these further exacerbated these issues as it relates to mark-to-market losses, right? With these held-to-maturity securities. And who knows what that starts to affect, especially as the regionals fail or get kind of bundled up into some of these larger names and the sort of risk that there's in those portfolios that some of these bigger banks have. So to me, that's why I bring it up. So a little fear in the stock market might be a really healthy thing. And I guess next week, let's just say we do have the passage of the lifting of the debt ceiling. And let's say it is to September 30th. And then we know that there's going to be a looming budget debate. And that will be partisan, because when we get to the fall, we are 1 year out from the presidential election, and that is all on the record at this point. You know what I mean? So like, so that's why that's important to me. So I think with the S&P up 9% on the year, the NASDAQ 100, you ready for this, people? Up 25% on the year, which is wild because it's almost as much as it was down last year, Liz.
Yeah. Yeah. Well, and try to square that with something like somebody put in the comments very early in the show, talk about the leading economic indicators.
Yeah.
Try to square what the NASDAQ has done, which historically, maybe not today, but historically had been the highest beta index, right? It was the one that was the riskiest. It was the one that was depending on the future. And then you look at leading economic indicators, the index year over year, just falling off a cliff.
Yeah.
It's down almost to where it was in March of 2020.
Yeah.
So all of these signals, plus the inversions and all the other things that are happening. I know we're going to talk about housing because I wrote about it today because it continues to confuse me. But these signals, and then you see the market happen. It's almost as if, you know, if I go to somebody and say, give me your bull case, because I legitimately want to hear it. Give me something that convinces me to be more positive. I might get some little anecdotal things like housing is still strong, unemployment hasn't blown up. But then mostly the answer is, well, the tape. Right?
The tape.
The market.
Yeah.
The market keeps going up. So that's the bull case. That's called momentum. That's not necessarily a fundamental bull case. And my theme continues to be this year. Somebody's wrong. Maybe it's me, but somebody's wrong. One of these signals is wrong.
Well, I just told you, in the last 3 months, I've lost more money trying to be bearish than I made being bearish in all of last year. And that doesn't feel particularly good, but at least I have about 6 or 7 months to try to make it back, Liz. It's interesting when you think about the NASDAQ 100 in particular, and we talk about this a lot, but a name like NVIDIA has gained $400 billion in market cap this year alone, right? And then I look at an Apple is up 34% of the year, a Microsoft is up 33% of the year, a Google that's up 38% of the year, Amazon's up 40% of the year, Meta's up 100% of the year. When you think of that, I mean, that is all the gains in the market. I mean, like literally, those are all the gains in the entire stock market. We talk about small caps, which is equal to the Russell 2000, equal to the market cap of, let's say, an Apple or a Microsoft, and it's flat on the year, or up a little bit. So to me, there's definitely some bifurcation here, plenty of dispersion, which we didn't see last year. So that's something I think we got to keep an eye on, because sooner or later, people, this bubble, and I'm not saying that there's a bubble in the technology, there's a bubble in the enthusiasm about these large platform companies being able to kind of, take advantage of these new technologies working through their platform. It's just not, I think they're front end loading a lot of that. All right, let's talk about housing, because this is really just like employment. And again, going back to being confused, you've talked a lot about housing is probably one of the most confusing aspects of this economy. We know it's a huge part of the economy, and you had a great note. And I got to tell you, it's a bummer Guy's not here, because Home Depot, I mean, that is on the Mount Rushmore of titles that could tweak Guy Adami like you don't even know here. But you made a lot of great points about the supply demand dynamics. But the one thing that I thought was most important, and we can get to it when you're ready, was just there are implications on the employment front that are very tied to the housing market. And so a couple of those things going in the wrong direction at the same time could be bad for the economy. So talk to me like why this is front and center, especially on a day today where we have the housing data, which was worse than expected.
Right. Well, the idea for this column, and I LOL'd when I came up with Home Depot.
Did you LOFL?
Freaking. It'd be ROFL.
What is
that?
It?
Oh, rolling on the floor laughing.
Oh.
Or LFM.
I don't know. I'm too old for this shit.
LFMAO.
It's funny. Remember those guys, the LMFAO guys?
Yeah.
You know what's so funny? I have an amazing picture, and I'm going to try to find it when you're going to go through your note here, of me with the guy, the guy who had the big afro, the guy from that song.
Yeah.
What was the song called? They were just dancing all over the place. Yeah. I was at
something about a girl on TV.
Something. I don't know. I'll try to find it in my iPhone, but it was amazing. I was at Madison Square Garden, and he was there. It was like, they used to have this tennis match. This BNP Paribas had this like tennis match in Madison Square Garden, which is kind of like a cool event to see in Madison Square Garden.
Yeah. I'm not a tennis gal, but
no,
I'm sure it would be cool. Anyway,
so you're saying you're not athletic or no?
I think I'm very athletic.
Oh, really?
I don't play tennis.
Okay.
I use bats, not rackets.
Diaz, can we get eyes on that? Don't we have a picture of Liz in a softball uniform? Well, we definitely have the cheerleader.
I'm sure my dad can come up with a picture of me in a softball
that
uniform.
would be amazing.
Okay, Home Depot. So
sorry.
Here's the thing. I did tie this one particularly to employment. But the reason that the idea for this column came out of the fact that homebuilder sentiment was reported this week. I think it was on Tuesday. And it actually had improved, where it had looked for a while like homebuilder sentiment made sense with where we thought the economy was heading and all the different things that were happening, because it had gone into contraction territory. We expected that prices would fall, all blah, 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 right? And then it sort of popped back out of negative territory, and suddenly homebuilder sentiment was good. So then it got me thinking, okay, well, what does that mean? I know we have a shortage of supply, right? Fascinatingly, people are still willing to buy houses. I mean, my little sister just bought a house, and she's, not in finance, but at a time in her life where her and her husband want to start doing that. So I get it. People still want to do it. It's fascinating to me that this is still an environment with rates higher than they've been in however many years.
Well, can I just back you up? If you're a first-time buyer, you're thinking about your current housing costs.
Yeah.
You're thinking about your employment and your wages. You're thinking about your future confidence and all those sorts of things. And then you're basically saying, that's the house that I can afford. That's the rate that it takes to get a loan on 80% of the house or whatever. But it's the people who have their house that they bought with a maybe adjustable 10-year arm that's 2.5% or something. Those people are not moving. Right?
Exactly. And that's part of the point. She's a first-time home buyer. So to her, 6.125% on a mortgage is like, okay, that's just how it goes, right? That's going to be normal to her. Whereas if you've got you're sitting on a 3% 30-year, I'm not going anywhere either, right? No. I'd rather keep that house, rent it out, and then go do something else for a little while, which is what a lot of people are doing.
The CEO of Redfin was on with Sarah Eisen this morning. I was watching a little CNBC this morning. I was waiting for you to come to the studio. And, he said to that point is like, if you have a 3% 30-year mortgage, that is a financial asset now. When you think about it, because you can put your money, SoFi has a high yield savings account. You can get probably 4.5%, maybe even 5% in some of these sorts of things. So there's a spread to be made for the first time in a very long time, right?
Yep, absolutely.
Yeah.
So the interesting thing about the housing market is that all of the normal signs, right? Housing affordability has plummeted, rates are higher, you've seen mortgage activity slow. The housing market continues to look resilient when you look at prices. Now, I know prices have come down. I know there was a headline today that they fell the most in 11 years or something like that. But they're still pretty elevated compared to what you would have expected to happen if you look at mortgage activity and if you look at mortgage rates. Prices have stayed elevated, which I think you can draw two conclusions. And that was one of my points in here, is that you could say, oh, well, it means that the housing market is still strong. There's still so much demand. Or it means that people just aren't doing anything about it. The market is frozen. Housing is something that you don't get to market until the house moves owners. And if it's not moving owners, we don't really know what they cost. So part of the point of this was, look, it's not that the data is strong. I think the data is actually stale or stuck, and prices aren't actually reflecting what people are willing to pay for a house. The other piece of this is that existing home sales and new home sales are sending kind of conflicting signals as well. So we know that we have a shortage of supply. There's definitely more people than there are houses available, or at least more demand than there are houses available. We also know that we went through a pretty long issue with supply chains, and we went through a pretty long issue with labor shortages. So you've got all these homes, the building permits that piled up, and then the homes that were started to be under construction that either went much more slowly than normal or just had to be paused entirely and still haven't been completed. So there's this big backlog of new homes still sitting there, or maybe being finished right now, but they're not being finished fast enough. So the backlog isn't clearing out. So you've got continuing backlog, which makes demand look elevated, right? And stay elevated for a while. And you got to have people to build the houses. So it keeps the construction employment buoyed. And that's sending this sort of signal that everything's fine in the housing market.
Let's talk about that for a second. So that was the point I was making. And then we have another chart here, and this is a fascinating one. I think Guy calls this the hungry alligator chart, but this is like, this is the lumber prices versus the home builder, the S&P 500 home builder index. So if you think about it, one of the biggest inputs is wages, right? Like in access to workers. And that was one of the reasons why we saw home prices going up so dramatically during the pandemic, was because access to workers was hard. And then lumber prices shot up, right? So we had this really like perfect storm for pricing in the housing market relative to this weird supply demand dynamic. So now you have this situation where prices of the home builder stocks, have done what they've done. You see lumber, one of the main inputs, go down, but you're seeing stable wages and still strong demand for construction workers. So what does that combination, like let's bring it back to the stock market in a way. Like, do you see lumber prices not being able to go too much lower, especially if demand continues to pick up? And then if wages stay bid, isn't there a chance that margins get weaker in the home building space here? And maybe it's not a great spot to pile into the home builders, even though they all trade at like 9 or 10 times earnings.
Yeah, I mean, just looking at this chart alone, right? Yeah. Lumber is supposed to lead the housing market. I mean, I don't know that lumber needs to go that much lower from here. It looks like it's kind of flatlined. If there's a recession, obviously you're going to see things like lumber go down even further. But just the divergence between these two, right? You see home builders taking off. This is the other thing. There are also long legs in the housing market, right? You agree to build a house, I don't know, in January. You don't really even break ground for months still. And then to get it from breaking ground to completion takes a year sometimes, right? So there's this big long leg. Be careful in extrapolating out what's happening today and assume that it's going to keep happening, right? There's reason to believe that there aren't as many permits being taken out. There isn't as much.
Great song by Bruce Springsteen.
And more than reason to believe, the housing permits have actually fallen.
You know, and I did
just so it'll slow down.
So you people know, on April 1st, Bruce Springsteen was in Madison Square Garden. I did invite Liz to join me at the concert, and she said no. I mean, like, I don't even know what the hell she was doing that night. Okay, but like, who says no to that?
I mean,
with me,
you know,
the boss. And the boss? No, I didn't do that. Did I just do that?
Who's the other boss?
Me, Dan the man.
You're the boss.
And all right,
and he's the boss.
Yeah. You didn't.
I mean,
all right, but
you
next
know, your
time.
wife told me about the concert. I feel like I was there.
No, trust me. All right, you know, here's just let's put a let's wrap up the home building thing, and you guys can all find Liz's note, the Home Depot at the SoFi Investing blog. And just, you know, you guys have a daily newsletter, SoFi, that I get. And I think it's really good too. So you guys should go check that out. My friend Doug Cass at Seabreeze. Doug, I got to tell you guys, you know, we love quoting Doug on the financials. He, as I say all the time, has forgotten more about bank stocks than I will ever know here. But, you know, he says to me, and he's listening, thanks for listening, Doug, is we've been long home builders all year and short Home Depot. And I think this is really interesting. And he says, because the remodeling jobs are principally funded by refinancings, and there are no refinancings. This is to your point. And I wanted to bring this up a little bit because we have these charts now, and I want to take you for as good as the home builders look, and they look like they want to try to break out. And again, I'm not saying to chase them here. There's a bunch of weirdness in and around the space. Okay. So look at Whirlpool. We have this chart. If you buy a home or build a home, probably more if you build a home, you likely have to put a washing machine and a dryer and all that sort of stuff. Look how poorly Whirlpool trades. It's very near its 52-week lows. It's been cut in half from its pandemic highs in 2021. It was like trading at like 250 or something like that. I think that's kind of interesting. You know, a Masco.
Hold on, I have a question.
Yeah, but whatever.
And this is, I know we're getting close to
the end, we are getting close.
But okay, if you're going to build a house, I don't know how many new houses I walk through, and I've gotten a new washer and dryer in the last year. It's not Whirlpool, right? It's LG.
Yeah.
So is this really something that we should look as an indicator of that kind of stuff? Or is this like, is Whirlpool the Kodak of, you know what I mean?
No, they have good market share. I mean, whatever. Well, I mean, just because you like to buy Korean over like over the Americans thing, but I just like I'm just saying, look how poorly that stock trades. The Home Depot, to Doug's point, I mean, they just had a very disappointing quarter. What they had to say wasn't particularly great, and that stock does not trade that well. Another one was RH. You build a home or you buy a new home, you're going to go get a new tricked out sofa, maybe something from the Ottoman family. I don't know. You know what I mean? Like, like just to kick those feet back up.
Do you know what an Ottoman is?
But like, but like it trades pretty weird. All right. We are getting late here. I want to hit two, I think, really important areas here. I want to hit retail and I want to hit semiconductors and tech here. So let's hit retail. First this morning, Walmart, you know, decent quarter, decent guide. I mean, like without getting into the weeds here, you know, we know that half of their sales come from groceries. Okay. And that's been something that, okay, if you're trading down, we've heard this trade down narrative from lots of retailers. We heard it from Home Depot. We heard it from Costco last month. You know, like Walmart's in a pretty good spot. If you're going there to get your groceries, you're probably going to get some other discretionary items. But then what Target had to say wasn't particularly great either yesterday. Thoughts on retail? Because look at this Walmart chart. It's right back towards those late 2022 highs, the late 2022 highs. Technically, it had a big run. It really traded lockstep with consumer staples, if you think about that March move here. And so expectations were only high because of what the stock had done. Trades about 25 times versus a target about 19 times. What is your take on retail in general? Because I'm going to pull up the XRT chart. This is the S&P retail, and this thing can't get out of its own way. It's one of the few sector ETFs that's below its 200-day moving average. Talk to me, Liz.
Look, retail is probably one of the latter things that actually breaks down, but I think it's running up against its own sort of resistance. And although Home Depot is obviously a housing adjacent name and something that is going to be much more affected by what people are doing at home, the message I think is really important to listen to. They delayed bigger projects, right? They stopped buying bigger items. Durable goods, just as a macro lesson for everybody, when you see durable goods start to relax and turn the other direction, that's usually a leading indicator of slowdown in regular spending. Durable goods happens first, smaller retail stuff happens later. I think there's some unique stuff between Target and Walmart because we know about the inventory problems that happened earlier in the year. This was the quarter where we got to find out whether or not that was the worst of it. Did they figure out the inventory stuff? And it sounds like maybe they did for the most part, but now the concern will be when spending pulls back, right? And if you are doing that trade down. But I don't know where do you trade down from after Walmart?
And those stocks, dollar stores and stuff like that, those stocks got nailed about a year ago when it made very clear that like the inventory that they had was not what consumers were looking for, especially as we'd gone from this period where there was a lot of big ticket purchases when people were locked at home, savings were high, they had nothing to do. And then you made this point when they moved to doing things, you know what I mean? Like they were not professionally or properly stocked. Last point I'll just make is like TJ Maxx had a good quarter, and I think it speaks to the trade down a little bit there, but that's worth noting. All right, I want to make this last point here, and I thought this was a really interesting headline. Steve Cohen runs Point 72, formerly SAC Capital. That's actually the place where I got started in the business in 1997.
So you got a soft spot.
I don't have a spot in general. I mean, he's clearly, I think people will refer to him as like the Michael Jordan, the GOAT of trading, and he runs a massive firm. But it was interesting. There was a SALT conference co-hosted by our friends at iConnections. It was in New York, and I guess this Bloomberg article is quoting him at a private meeting where he said he's pretty bullish on the markets, and thanks primarily to AI. And it's funny, I see that headline, and I swear when that came out yesterday, I saw the NASDAQ just start ticking up. The permission structure that you get as a PM or a trader when you hear that from somebody like him. Now, this is about as useful as 13F filings, okay? Like, meaning, like, you know what I mean? Like, who knows what his time horizon is? Who knows when he bought this stock? Trust me when I tell you that Steve Cohen has the most brilliant people who are supposed to be 6 months ahead of the curve, whether it be macro stuff, whether it be micro on an individual stock level, whether it be a sector, like, transformative sort of tech level. So he could be reiterating a view. He could also be selling into that view, you know what I mean? Because things are getting a little nutty here. And I just think that's kind of interesting because I suspect a guy like that makes a lot of his money being contrarian. And I don't believe right now with the NASDAQ 100 up 25%, going all in on these huge AI stocks. And they're not AI stocks. If you're looking at any of the big platform companies, they're going to use AI inside of their own businesses, you know what I mean, to get, better productivity or better monetization or better whatever. But that's not something you're going to see and feel right now. Maybe NVIDIA is seeing it with their orders for advanced chips for all that stuff. So my question to you, let's pull up the NASDAQ 100 chart here. It just got above its August of 2022 highs. It seems like there's a lot of good news priced in right now. And I'm just curious, when you hear like a market luminary like that make a call like that, are you a little skeptical? Not skeptical about his prowess in the markets, just about the timing of when it comes out.
Well, I would argue it's sort of a contrarian call compared to everything that's in the economy, right? But maybe it's not a contrarian call to the NASDAQ. I mean, it does make me skeptical. The AI thing makes me skeptical. I'm not skeptical about AI. I think AI is going to be a big deal.
Of course.
But I don't think it's going to change our lives.
The way Web3 was, or the way that like the metaverse was,
the way that
Bitcoin fixes everything. Right. Got it.
All the same stuff.
I just want to be really clear on that.
But it's not going to change our lives in the next 5 months, right? Even if it is this big thing that everybody is expecting it to be, this is a 5 to 10 year story. And keep in mind, if AI takes over, people lose jobs. So that's actually not good for parts of the economy. And there are always going to be conflicting signals and things that something gets better and something else gets worse. So it's not just sort of a cure-all. And I think the the swiftness with which many of these companies have gone up because of the enthusiasm, it's almost like, do we not have anything else to be enthusiastic about this year? Maybe we don't, right? So we're trying to like grasp onto something to be happy about, maybe. But this is also not something that you're going to get gratification on by like December.
It's interesting. I want to highlight, maybe Amanda and Jacob could find it. There was Chamath Palihapitiya, who runs Social Capital, and a private tech investor, but also invests in public markets. I think on Twitter, someone shared it. I'm not on Twitter. Elon kicked me off. Somebody showed me this tweet yesterday that he quote tweeted that Steve Cohen article, okay, the Bloomberg headline with that, saying it's really I think I'm paraphrasing here, maybe these guys can pull it up, paraphrasing, but he said it's really interesting that this time all the excitement about AI is not coming from Silicon Valley, it's coming from Wall Street, which I think is, and that's really, now listen, it's being reflected in private market valuations. We've seen plenty of AI companies that are pre-revenue being minted with $1 billion valuations. And I just think, thanks guys for bringing that up. I just think that this is a really interesting point. And I think we're going to continue to have this push and pull between Silicon Valley and Wall Street, because right now, the only way that you can invest in AI is buying Microsoft or Google or what you think Amazon's going to do, or a Snapchat headline in and around it. And we're going to, ServiceNow had it something. NVIDIA, again, has gained $400 billion in market cap this year, solely based on the belief that they're going to be the ones selling most of the advanced chips. I'll just mention this, NVIDIA was data center, it was gaming, it was crypto mining, and there were big peaks and valleys as it related over the last few years around all of those things. And I do not, and I've been short NVIDIA, and I'm getting my balls blown off on this one. Sorry to use that technical term here, and I'm just being really honest about that. But my point is like, there will be, oh, thanks guys for bringing that up. And that means just right up the keister. That's what that looks like. So sorry, we got
a chart you don't want to be short.
No, but yeah, not pretty. But they report next week, and I think that's going to be an interesting one. I just can't imagine. I mean, like the quarter and guidance list that they're going to have to put up to kind of keep this thing going is just
well, and that's sort of my point, is if you're investing in these stocks now and you're excited about AI, I'm not saying that it's the wrong thing to do. I think you should be excited about AI, but if you're looking at this now at these valuation levels and expecting that by the end of the year, you're going to say to yourself, you know what, it was worth 80 times forward earnings, right? I don't think you're going to get that gratification. I don't
25 times sales for a company that's a $750 billion
right. I don't think you're going to get the satisfaction in a reasonable investor time frame to say that was the right decision, I'm going to keep holding. So there are going to be bumps, there's going to be peaks and valleys along the way, and not every company is going to do this well. That's how every new innovation comes out. Everybody tries, they don't all succeed. So there's going to be probably some really big winners. Maybe NVIDIA will be one of them, but there's also going to be some companies that don't do it well at all. Listen, and it falls apart.
Every one of those companies that I just mentioned is going to be, they have been using AI, or they have been building systems or hardware or whatever you want to service this new transformative technology. But there's no silver like bullet. There's no one thing. It's like, how do they integrate it in the things that they're already doing, and or augment the services that they're selling to others? I mean, that's the story here. So to me, it's like, what have we discounted right here? And again, being early is being very wrong in my case here. So that's a tough one. And again, I remain very optimistic about the prospects for a lot of these companies to do it. And then it'll be really interesting. Just wait until the IPO machine gets turned back on and the SPAC machine gets turned back on, and AI stocks are going to be the first ones. All right, before we get out of here, and I just want to say this, we've gone late. We appreciate you sticking with us. Most importantly, Liz, I think she's been so generous with her time because we just had like a nice sushi lunch before this. So I think we kind of primed the pump a little bit here, and we went over the top on it. We did a nice little sugarfish box here. All right.
I accept all free food.
All right, let's hit hashtag Butters right here. So this is John Butters. He's the senior earnings insight analyst over at FactSet. We get a preview of his earnings insight blog that drops every Friday morning. And this one, Liz, I think is really interesting. We've been tracking John Butters' work all during earnings season, and he really helped us set up into it and getting our sense of like what expectations were for how much earnings estimates had come down over the quarter, what the average kind of decline has been, and like that we've seen in these sorts of periods, and what the beat rate was to that. And so we've been highlighting the fact that yes, they came in slightly better than expected, but they came down much harder during the course of the quarter than they had on average over the last 5 and 10 years. So now we're looking at the term recession. Okay. The term recession has been cited on the Q1 earnings calls of 105 S&P 500 companies. This number is above the 5-year average of 77, above the 10-year average of 59. However, Q1 2023 marks the third straight quarter in which the number has declined after peaking in Q2 of 2022. The financial sector has the highest number of percentage of companies citing recession on Q1 earnings calls. In addition, the term debt ceiling has been cited on the Q1 earnings calls of just 13 S&P 500 companies. Interesting. So talk to me about why financials, and I know the answer, but let's inform everyone, why financial companies were probably much more in tune about talking about recession than, let's say, others.
Well, this is all about feelings, I think, too. You know, you talk about it's not a recession to you until your neighbor gets laid off or until your brother gets laid off or until somebody in your house does. If you were in the financial industry in the first quarter of 2023, it didn't go so well towards the end. And it really felt like there was either a crisis that had already begun or a big one that was brewing. And when you finished out March and saw, you know, a handful of banks that had either failed or were on their way to failing in that industry, of course, you're talking about recession, right? And if you're outside the industry, you're looking at one of the most cyclical sectors and saying, oh my gosh, if you have a scar of any sort from the global financial crisis, there were eerie similarities and it didn't feel great. So then the fears went up, which is also the exact time when that yield curve uninverted by at least 20 to 30 basis points, right? So I don't think it's any surprise to anyone that financials would mention it more. I do think it's interesting, though, that even during a period where, and I don't have that chart in front of me from Butters anymore, but even during a period when we knew a recession had happened, so Q1 2020, Q2 2020, not even half of S&P companies mentioned it. So that it was a certainty then, and not even half of companies. So I would argue that over 100 is still a pretty big number.
Yeah, it sounds like it. All right, well, that's going to do it here, people. Guy Adami, congrats to Guy Jr. He's going to be back with you and me Monday morning. We do an on the tape podcast that would be Liz, Guy, and Dan, and that will be in your favorite podcast stores or wherever you get them. And then Guy and I are going to be back for a market call on Monday at 1 o'clock right here. So if you are here and you don't follow our Risk Reversal Media channel on YouTube, please do that. And we're going to be back with Carter on Monday. So that's going to do it here. Thanks to SoFi. Get your money right all in one app. And of course, FactSet, all that data and the analytics and the charts that we show you is brought to you guys by FactSet. We rely on them a great deal for everything that we do. So thanks to them for their support. Liz, have a great long weekend. Thanks for going over time with us. Thanks. Bye-bye.
Of course.
All right. Bye.